folks, fellows, and partners in crime. Let me welcome you to a brand new session of the Finance Real Talk. Today it's all about stocks and what beginners should consider. Stocks for beginners, that's what's about in today's videos. And Mike is going to show us what different types of stocks exist on the market and how you are able to evaluate the true value of a company to consider an investment or to avoid an investment maybe. I will also insert the link to my social and copy trading video afterwards by the end of the video, and hope that you understand and get the right sense of feeling for investments after the video. Would be great when you can leave a comment in the section below. Spoiler, that is just the first part.
Hi everybody, this is Uncle Mike, as my partner in crime Gökhan baptized me. But first off the bat, I'm not a financial advisor, nor a financial services professional. These are just my 2 cents on a matter that I'm very fond of. So let's get this show started to hopefully a series of videos of the stock market. But first of all, what are stocks? So a brief history on how this all got started date back to the age of Christopher Columbus, when a group of Dutch merchants wanted to send their large vessels over to the New World to start trading spices, furs, and all other kinds of good stuff. This of course required loads of capital that no single merchant could come up with on their own, so investors started coming together to consolidate their money and become co-owners of these trading companies. These ventures were called joint stock companies. Shareholders started buying and selling their stock with other shareholders and investors. This was how the stock market was born. This idea was so successful that joint stock companies started popping up like mushrooms here in Europe. And as this idea increased, it was then inevitable that some sort of organized marketplace had to be established to buy and sell these shares. So the first stock exchange, believe it or not, was founded in a London coffee shop. And the first company ever to been recorded to offer the world's first IPO was the Dutch East India Company in 1602. This might ring a bell to all of who watched Pirates of the Caribbean with good old Johnny. So, why should you invest in the stock market? Well, it's been clearly one of the best tools to grow wealth over time. The market has averaged roughly a 10% annual return on investment historically. The second point is, savers are unfortunately losers. So everyone knows that having assets is better than just sitting on cash, especially with today's interest rates. But if you still have cash tucked under your bed, just understand that you are actually losing purchasing power by not investing. Because it has never been cheaper to invest. There are $1 or less for trades and fees, which are the norm for most brokerages for stocks and cryptos. The only reason I went to Binance is because they have super cheap trades. I think it's like about $1 a trade. So it's pretty much cheap everywhere. Also, there's low expense ratios for solid investments with index funds and ETFs through other brokerages. And finally, you don't have to be a genius. There are strategies out there that help you grow your wealth over time. A good source of today's strategies can be found on the internet. So, what exactly is a stock? It is simply a share of ownership in a company. So think of each share being a slice of pizza, okay? So when you buy shares, this gives you equity, ownership of shares in the company. So let's take Tesla for example, which everyone is familiar with. They have shares outstanding 960 million. So if you think of a pizza, think of it divided into 960 million slices, which is a bunch. This is essentially what shares outstanding are. So the share price, and just to let you know, I did create this presentation a few days ago, so some of these numbers may not be exactly accurate, but I will be showing you how to figure all this out. So the share price at the time of this presentation was at 661.75 cents. And we'll also need to understand what market cap is. Market capitalization is simply the shares outstanding, that's 960 million, multiplied by the share price. So let me give you a quick example of that, okay? Just so you can just visualize this in your head. Let's pretend that we have a pizza and that the pizza has 4 slices, and pretend this is a company, Pizza XYZ. let's just say that these 4 shares that you visually see in your head are each worth, let's say, 25 bucks. So 25 times 4 shares, well, it's just simple math. And this then tells us that the company's market cap is worth $100. So let's go back into the presentation here. So now that we understand market cap, you just simply take that 960 million multiplied by the share price of Tesla, which is $661.75, and in total, Tesla has a market cap of approximately $635 billion. This is important because companies are typically measured by their market cap. Market cap changes over time because share prices and shares outstanding can change over time. That's like saying, hey, ABC company went up in price, or ABC company went down in price. That's obviously changing their market cap as time goes on. A stock split is a corporate action in which a company increases its numbers of shares by dividing its existing shares into additional shares. A bit of a tongue twister. The primary motive of this is to make shares seem more affordable to smaller investors, because this action does not only split the share, but also the price, which makes it actually more attractive for them. So, why do companies issue stocks? Well, this is simply to raise money for their business. Think of it like this: they're giving out their shares of pizza, their equity. That's why stocks are also called equities, in order to receive money from the general public in an IPO, initial public offering. That's basically crowdfunding for their business. They do this, for example, to fund a new product line. It can be used for R&D. It also could be used to invest in the growth of the own company, because a lot of companies themselves could be doing stock buybacks, which is actually reducing the number of shares outstanding. And then you also have companies paying off their debt. Then there is also a difference between a preferred stock and a common stock. So with a preferred stock, you have no voting rights, but with a common stock, you do have voting rights. However, you are the last in line to get paid out in case of liquidation. In case the company goes bankrupt and they have to sell everything they have, you are also the last in line to get paid out. It's a rough reality of being a common shareholder. And even if a company pays out dividends here, unfortunately, you are also last in line to get paid out. So, how are stocks categorized? This is important. So we have large cap, mid cap, and small cap stocks. If you remember, we talked about market cap. So market cap again is just shares outstanding multiplied by the share price. So large cap companies are typically $10 billion plus. It is typically hard to achieve massive growth due to their size. So think of huge, well-established companies like Johnson & Johnson's or Pfizer's or other large companies that have been around for years or maybe even decades. They have proven track records over many years, and they frequently offer dividends. That's because they want to offer the dividend back to their shareholders. It's kind of a thank you for being a shareholder in the company. The easiest analogy to make is that I'm renting Gökhan's house, so he's then actually my landlord. And the price of a property can go up, it can go down, just like the share price can go up and down. But the tenant, in this case myself, is paying Gökhan rent every month. That's kind of what a dividend is. Then you have mid-cap stocks, which are $2 billion to about $10 billion in market cap. They are not quite there yet, but they also have a more established track record than the small cap stocks. The problem with these mid-cap stocks are they're also often the target of M&As. So if you're not familiar with an M&A, it is simply mergers and acquisitions. Sorry about that. These are bigger fish that are eating up the smaller fish, either for their staff, their technology, or the owner just wants to get paid out and make a quick exit. Then you have small cap stocks, which are about $300 million to $200 billion in market cap. These are typically younger and are seeking aggressive growth, and they are typically higher risk and don't usually offer dividends. This is because They are so early on in their journey as a company of going public. So, how are these stocks categorized? We have growth stocks, we have income stocks, and we have value stocks. So growth stocks have big potential for growth. These are typically companies that are outpacing the market, such as Tesla, Facebook, Amazon, Microsoft. They typically offer low or no dividends. However, because they're reinvesting in their retained earnings into things like we talked about before. This could be things like research and development. Could be like things paying off their debt and so on. Then we have income stocks. So these are stocks that pay a regular dividend or a regular income payment. So think of your Walmart, 3M, or Target. Think of utility companies. These are companies that have been around for a long time and have the ability on their balance sheet to pay a dividend. So they typically have a proven track record or a business model, and they have consistent increases in dividends over time. And then, last but not least, you have your value stocks. So value stocks are perceived to be trading below their fundamentals. So think of something that's on sale or that's cheap. That is what we as value investors search for. We look at a price to earnings ratio or price to book ratio. And all these ratios we are hopefully going to talk about in a later session. And they are typically seen as unfavorable in the marketplace. That's why they are undervalued. So think of a diamond in the rough before it being cut and polished, where the value has been brought out. It's kind of a cheesy analogy from my side of value stocks. So continuing on how stocks are actually categorized, there are 11 broad-based sectors. These are areas of the economy in which businesses share a product or a service. So we have energy. This could be your gas, oil, coal, fuel, things like that. We have materials, which are chemicals, metals, paper. Industrials, which are your defense or aerospace, like manufacturing firms, something like Boeing or Lockheed Martin, for example. And consumer discretionary, this could be apparel, household products, things like that. Consumer staples, well, these are your food, your beverages, healthcare, your pharma industries, equipment like CAT scans from Siemens, for example. Financials are typically banks, so think of like your Bank of America, Deutsche Bank, all these big publicly traded banks. Number 8, which is the IT sector. Well, this sector has grown a lot over the past 10 years. So think of your Tesla, Microsoft, Apple, and so forth. And then number 9 is telecommunication services, AT&T and Vodafone, for example. You have utilities. So these are the big electric companies, gas companies, water companies. And then you have number 11, which is real estate, which could be REITs. These are real estate investment trusts, such as apartments, malls, office space, and we'll talk about this later in the presentation. So, now that we're understanding how stocks are actually categorized, we need to understand risk. Risk is the whole point of investing. This is how we are compensated as investors. We are compensated for the amount of risk that we take on. So what is risk? Risk is the chance that your actual outcome will differ from your expected outcome. Let's say for me, little Mikey, I'm starting to invest in stocks, right? And I think that Tesla is going to go $20,000 a share, and it ends up not doing that. That is the risk I'm taking by going into that position. So risk includes the chance of losing some, or unfortunately, even all of your investments. So stocks don't always go up. Then there's times when stocks do go down. So that is the risk what you're being compensated for. So for example, if I want to invest in a startup versus a savings account, I need to be compensated significantly higher for that amount of risk I'm taking for investing in a startup company which maybe has no proven track record or business model, versus just putting my cash in a savings account, for example, which is insured. Well, it's a quote-unquote probably a much safer investment. So there are different types of risk, a million different definitions and a million different types, but these 7 I've highlighted because I've come across them so many times throughout my research. So number 1 is market risk. This is basically the market as a whole. So if you think of or look at economic developments or other events over time, this can pose a risk to your portfolio. If you remember in 2008, some of you do, some of you don't, 2008 was a huge systematic risk that crushed almost everyone's portfolio. Of course, I'm just generalizing this, but I'm just trying to prove a point here with market risk. Number 2 is liquidity risk. So this is the fact that, hey, I can't sell this investment, it's not liquid. Let's say, for example, you own a huge warehouse in the middle of Buxtehude, for example. You know that warehouse may produce an income and may be worth something. But if you want to sell that warehouse, how many buyers would want to buy a warehouse in the middle of Buxtehude anyway? So that comes down to liquidity risk. Can you sell this asset quickly? Number 3 is concentration risk. You have way too many eggs in one basket, meaning that you have too many stocks that are probably similar, or you have all your money in just this one stock. Your capital is so concentrated that it becomes a risk. Number 4 is credit risk. This means that the entity can't repay. So the company that you're investing in, for example, can't pay off their debt, which causes them to liquidate certain things or causes them to go out of business. Then you have inflation risk, which is the loss of purchasing power. Let's say, for example, you calculate with 3% inflation, but in reality, it's about 5%. So you lose 2% of purchasing power, where you could have invested somewhere else. So think about that. Number 6 is horizon risk. This is your investment time frame if it changes over time. So say, for example, you're originally planning to getting into an investment and setting it up for about 10 years. However, you or your family member got sick and you have no other money. So you have to sell part of that investment after only a year because you needed to fund your or their medical bills. That's just a quick example that people can relate to. Number 7 is foreign investment risk. So this applies to foreign investments. So say, for example, I want to invest in the hottest new startup in, let's say, India, for example, and that startup just gets crushed or just gets put out of business instantly by the government for whatever reason. That is the foreign investment risk of them taking on by investing into that area or into that country. Okay, so moving on. What are the types of stocks or equities, or what are we even buying here? So number 1 is individual stocks. So when you think of individual stocks, this goes back to common shares or common stock that I've talked about. So when you're saying, hey, I'm buying a share of Tesla, or I'm buying a share of Microsoft, or maybe even a share of Apple, these are individual stocks. Number 2 is mutual funds. I'm not going to explain that here, but I'm going to go into each one of these in detail later. Number 3 is index funds. Number 4 are exchange traded funds or ETFs. Number 5 are CFDs. And then finally you have REITs, which stands for Real Estate Investment Trust. Let's talk about individual stocks, as I mentioned before. These are your Disney or your Netflix and so forth. These are individual companies or individual shares in individual companies. Some of the pros are that they have reduced or no fees to buy or maintain these. There's no management fee to own them, meaning you're not paying a professional manager to buy or sell these shares, and you're also not paying anyone to actually manage this investment for you. You are the owner of these shares. You have complete control and understanding because you're researching, you're doing your due diligence to completely understand what you're doing when you invest in these companies, and actually taxes are pretty easy to manage. The cons, on the other hand, are to owning these individual stocks are that they're hard to diversify. So if you're investing in one individual company, you're exposing yourself to concentration risk, as we talked about. So you're going to need a lot more and different companies to achieve adequate diversification. This takes more effort and time to monitor because you're always looking at their balance sheets and you're always doing your due diligence or reading, different financial reports to find that one gem to be underpriced, undervalued, or is a value stock in which we talked about. And then finally, you have FOMO. FOMO stands for fear of missing out. Let's say when you're in the fitness center locker room and all the guys are saying, man, I bought stocks of Tesla when it was about $100. Now it's, I'll say exaggerate, $1 million. So you start to get that FOMO and you want to buy in at $1 million because everyone else who bought it is making money, right? So let's go into mutual funds. Mutual funds are simply pools of money from the public to buy securities or assets or equities. Some of the pros of this are that they're extremely liquid. They don't have that liquidity risk when we talked about that earlier in the warehouse in the middle of Buxtehude. These are very easy to buy and sell and partake in. They're very diverse because they invest in a lot of different things. Most mutual funds typically have professional management, whether this is active, meaning that there's an actual portfolio manager, or a human being, or a team of human beings managing this versus passive, which we'll talk about later in the next slide. There's a lot of options you have: balanced mutual funds, you have fixed income, you have money markets, you have income producing mutual funds, so there is quite a lot to choose from. Some of the cons are that these have higher fees, especially if they are actively managed. Most mutual fees are not insured like your saving accounts in a bank. That is insured up to 100,000 euros here in Germany, when I recall correctly. Mutual funds don't offer that coverage or that benefit. Then they have large cash holdings, which means that they have to keep a lot of their money in cash. And then finally, it's hard to evaluate to make an apples to apples comparison from one mutual fund to the next. So moving on with index funds. This is a basket of stocks to mimic a certain market index. So if you're familiar with the S&P 500 or the NASDAQ, for example, these are all indices that are able to be tracked by index funds. Some of the pros are that they have low fees, actually extremely low fees, especially if it's passively managed. The studies have shown that these have outperformed active management over time, which is pretty crazy to think about, which is actually makes them extremely easy to own, manage, invest in, and achieve your goals over time. Some of the cons are that you don't have any control over the holdings, you are not picking individual stocks, you are basically just accepting what that manager or that passive fund is giving you. You have a lack of downside protection if stocks take a plunge. So if you looked at the ETFs or index funds after 2008, you know that they almost got hit just as hard as individual stocks. And finally, they lack different strategies. So moving on to ETFs. ETFs are simply a basket of stocks, again, to mimic a certain market sector that trade on an exchange. So some of the pros to this is that you have access to many stocks. So if you think of an ETF, think of one share just like you would buy one share of Apple, for example. Except that one share contains hundreds, if not thousands, of different companies or stocks weighted up to 100%. So one share is buying you a basket of stocks with an ETF. So they have extremely low expense ratios, again, because they're either passively or actively managed, which actually passes the savings down to you. If you don't know what expense ratio is, it is simply a percentage rate or annual fee to pay whatever fund you're using. So if I'm using a Robinhood ETF, for example, I'm paying them an expense ratio of, let's say, think about 0.5%. So they're easy to own, they're easy to manage, they're easy to invest in, and they're easy to achieve your goals with, just like index funds. However, some of the actively managed ETFs have higher fees. They also have a lack of downside protection because it's not a hedge fund. And then diversification is limited by focusing simply on one industry, if that is the case. Contract for differences, aka CFDs, is an agreement between an investor and the provider to exchange the difference in value of a financial product between the time the contract opens and closes. The investor never actually owns the underlying asset, but rather receives revenue based on the market changes of that asset. If that asset's value rises, he'll receive a profit, but if it decreases, he takes a loss. Essentially, the investor is predicting performance. Let's say Gökhan believes stock A is going to rise. He decides to enter into a contract with a CFD broker. He agrees to buy 100 shares of stock A at $10 a share. The CFD broker requires Gökhan to only pay 5% to enter that contract, so he pays $50 instead of $1,000. And as Gökhan expected, stock A increases in value. On closing day, he sells it and pockets the difference in values as profit. The advantages to CFDs include access to the underlying asset at a smaller financial commitment rather than buying the stock outright. They also provide access to a variety of global markets and indices, lower fees, ease of execution, and the flexibility to go long buy or short sell. Disadvantages include market risk, which grows amid volatility, and when entering a CFD, the investor's initial position is reduced by the size of the spread, the difference between the asset's ask and bid prices, which can trim your profits. So to round this out, we have REITs, which again are real estate investment trusts. This is a company that owns, operates, or finances income producing real estate. So the pros of this is that you actually have access to historically an inaccessible asset class. This used to be for the rich and famous, the super wealthy. Peasants that were middle class and lower class, what business did they have investing in commercial real estate, right? Well, with REITs, they have actually allowed these companies to go public and make them very liquid and actually give the masses access to their balance sheets. So you get stable cash flow through dividends because REITs have to pay out most of the income they produce. And historically, commercial real estate has been a sound asset class. It's definitely a wealthy person's game, at least on the physical side again. With these REITs, you are partaking in actual physical real estate. Some of the cons are that dividends are taxed as regular income. They're subject to market risk. So if you look at the economy downturn in 2008, a lot of commercial real estate got absolutely crushed in the real estate bubble. So cons, you can have high management fees, and sometimes these operators may end up paying themselves. So that's the end of part 1 for stock investment for beginners, and I hope I could help you understand what stocks are. Thanks for listening and stay safe. Uncle Mike.
Hope that you enjoyed the content and have now more insights about the stock market and stocks and what different types we have in the market. And consider already your first trades, or you're already an experienced trader. Again, we're not financial advisors. That is not a financial advisory. We're just sharing with you our thoughts and ideas and opinions, and the rest is up to you guys and ladies. Highly appreciate if you could hit the like button and already subscribe to our channel, and if you don't have, so smash also the subscribe button and let us know in the comments what kind of videos you would like to have or which topic you would like to cover in one of our next videos. So stay safe and healthy, take care, and see you soon.